Hey everyone, Thursday, 8 a.m. Pacific means as part of our expert series, we are bringing back Matt Seamus to the show. How you doing, Matt?
I'm doing better than last week, Michael. How are you?
I'm doing very well. It's like, what is it, like day 10 or something for us Bay Area folks? People are starting to go a little stir
On
crazy on this.
lockdown? Yeah, you're right. You're right. It's I think for us at least, what's today? Thursday. Tomorrow will be 2 weeks for us being kind of locked down in our home.
Yeah.
So yeah, we're kind of halfway through, or more than halfway through.
Yeah. So pretty cool. So what I thought I'd talk about today, because, when we've spoken over the last couple of weeks, you've talked about deals you have in flight, both selling and buying. I've been have some selling and buying going on. So I thought we'd really break it down and talk about what's going on, because in the last 2 weeks the world has changed, and I thought we should just go into it. So you want to talk about maybe where do you want to start, buying or selling? I'm happy to go either direction.
Well, let's start with I can give you a sense of I can give you some context on how we're just kind of generally what we're
Okay,
doing, and then how
sure.
buying and selling fits
Perfect.
into that approach. So the most important thing that we're doing right now, we did this this week and last week, was really looking at our portfolio and determining, kind of assessing our health of each property,
Mm-hmm.
and determining, is there something that we can do to improve our position immediately, and if we can, we want to go do that.
Okay.
So that was kind of the first thing that we did. The one immediate obvious action item is, can you refinance any debt that you have and get a better rate?
Mm-hmm.
So that's something that we're exploring on two of our properties.
Mm-hmm.
We are, and then we're looking kind of separately at ways to maybe actually take advantage of potentially an opportunity for some of our commercial properties, where we might be able to provide some of our tenants kind of cash flow relief in the short term, but get maybe some longer term out of their leases in the long term.
Mm.
So we actually think we're maybe in a position to scenario that that might benefit everyone long term. So we're looking at those opportunities. Um, and then we have a property that we just entered into contract to sell.
Mm-hmm.
This is actually a land development deal.
Mm-hmm.
So on the risk spectrum, this is highly risky, because it's land. It doesn't produce any income. And so that is definitely on my mind right now, is just kind of we entered into contract, but we have a long way to go before we close. So we're selling one property, and then we are in contract to purchase two properties. And we entered into contract kind of at the very, very early, really kind of before the coronavirus scare became what I would call, real from the U.S. perspective.
Mm-hmm. Yeah, so that's great, because again, I think people need to hear about what's really going on from guys doing deals, or folks doing deals. So as far as my business, we have entered into contract to buy three. I actually closed one, and mine's residential, right? Totally different scale, but same deal, right? So I closed one last week. Have two more that are supposed to close in the next 2 to 3 weeks. Escrows are taking longer. So again, that's kind of a squishy timeline for sure. But I fully anticipate closing those. They're distressed assets that I will pay cash for, and then hold as the residential market kind of heals itself. I'm also been in a contract to sell a couple of things. Those are taking longer. Appraisals are taking longer. They're now, thanks to Freddie and Fannie, doing drive-by appraisals, because appraisers were scared to go in people's houses, right, with this thing going on. So, buyers are nervous, sellers are nervous, but really the investors that I sell to, they seem to be moving forward, right there. They know their return going in. This particular house is a Section 8 house that's producing above average income, and a nice, put numbers on it. It's a 150K house rented for 1350, right? So with a 4% interest rate, which this buyer got, is, it's easy cash flow. So business is still happening, but when you talk to agents and everybody out there, they're just, in the residential side, they're just freaking out. So I expect to be pretty busy on the acquisition side this year is kind of how I look at it.
Yeah.
Yeah.
We have a couple investors of ours who are selling properties that they own in their personal name and are going to 1031 exchange into, one or more of our deals. And they are fingers crossed that the transaction closes, at the predetermined terms.
Yeah.
This is the epitome of it's never done until the contract is signed and the money's in the bank.
Yeah. 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 You're so right. Now let's talk about a couple of your deals, right? Because they're bigger dollar values and in bigger units. So I want to talk about the two that you entered on.
Yep.
Because through no fault of your own, I think you've probably seen two changes while you're in escrow. Again, just giving the timeline, right? So first off, rates were slashed. First cut was a half, which I think really did fall to the bottom line, and you probably saw the opportunity for lower rates.
Yep.
Then they cut by a point, and then the world got on fire, and then rates actually went up.
Yeah.
And if what I see is true in the commercial space, Fannie and Freddie just instituted all kinds of new requirements for escrows, which means not only significant dollars, but I'm guessing the returns that you can provide on the asset go down because it takes more cash. But again, I don't do what you do. I'm just looking at the numbers. So, can you talk about kind of how this, at least from the debt side, how this has all changed since you just went into escrow?
Yeah, so we have two properties in contract. One is a flex industrial / office space, so commercial property, and one is a multifamily property, 136 units.
Okay.
So you have two different sources of debt. On the commercial property, our debt source is actually a credit union.
Oh, okay.
You're exactly right. Early on, when the Fed cut rates the first time, that was immediately a signal to current owners that, hey, I might have a better rate available. I need to call my lender.
Mm-hmm.
And so that happened, pretty quickly. Lots and lots of people issued applications for refinancing. When the Fed cut rates a second time, my interpretation of how banks and lenders are reacting is that there's a lot of uncertainty, there's a lot of volatility. The economy, we are likely already in a recession, and if not, it's seemingly going to be impossible to avoid. Mm-hmm. And so I think the combination of the uncertainty and the drastic daily fluctuations in the in the 10-year Treasury, combined with this dramatic increase in volume of loan applications, basically created this supply-demand imbalance in the lending markets, where you have this tremendous demand for new loans because rates theoretically are lower, and and then the supply is actually constrained in a couple ways because, number one, people just have limited capacity to process applications and issue loans. But number two, I think that capacity is actually reduced given the shelter in place and work from home guidelines throughout most of the country. So I just think it's harder, it takes longer, and it's more difficult for lenders to get anything done right now. And we've heard that some lenders have 5 times their normal volume right now. Wow. So what that means is lenders are simply saying, listen, if the deals, for many of these deals, we're going to price them actually relatively high, because that's a way of us saying, listen, if you want to do the deal, we will, but we're going to charge you quite a bit to do it. So even though the environment suggests rates should be low, the way that lenders are behaving is not necessarily in line with kind of the overall environment. And it really just depends. I would say, to my knowledge and from my perspective, Fannie Mae and Freddie Mac on the multifamily side are probably amongst the most aggressively sought after lenders. So their rates, their spreads are pretty high right now. The rates are pretty Freddie Mac, so we can kind of talk through that if we want to.
Mm-hmm.
But we have a local bank in Southern California, actually several local banks and credit unions in Southern California that are interested in refinancing a property that we have in Santa Barbara, and they're offering really, really aggressive terms. So I think it just depends on who the lender is, what their kind of demand and book of business is looking like. And of course, it does depend on the project. The more marginal the project from the lender's perspective, the easier it is for them to say, I'm just going to price this out of reality so that you don't proceed with the loan because we don't want to take it on right now.
Yeah.
That's kind of high level what we're seeing.
Yeah. So so you got two deals. You got the flex office space and the 136 units. Knowing what you know today, do you change your thesis? Do you walk away? Do you walk away from one of the escrows? I'm sure you think about it, right? I mean, I know nothing about your business or this market, flex office, but I got to imagine your thesis on that space is maybe not as rosy as it was 30 days ago. Maybe, I don't know.
Well, this is interesting. So I think you're right. You have to be really critical. And I think now is a moment to be even more self-critical than any time in recent years.
For sure.
We have, in the last couple of years, as we've built up our portfolio, we have taken the approach that we are only going to buy assets when we are confident that they're going to do well during an economic downturn. And we're going to position them accordingly. So generally, we have more cash in the bank than we need. Mm-hmm. And we have generally lower leverage than we could have gotten. And those were two important just decisions that we made to kind of make each of our deals a little bit more conservative. And when you do that, you have a lower return profile for sure. Mm-hmm. But you're also better positioned. You're in a safer position if your tenants can't pay, if you lose a tenant unexpectedly, if you have a higher vacancy in a multifamily than you expected, if you can't push rents the way that you might have expected to do. So we chose that approach because we felt like there was going to be an impending downturn. So that's kind of, we did that. We've done that all along, but now we are being even more cautious and scrutinizing in our due diligence. So we are really looking closely at, do we want to own this during a downturn, and do we think it's going to perform well? But the one interesting thing is high quality real estate, is generally it's not necessarily correlated to the equity markets. It's not going to move up and down the way that stocks do. And in an environment where stock market volatility is really high, a high quality piece of real estate that produces steady, consistent income, even if it's a relatively low income, on a risk adjusted basis, is a really strong return. So those are kind of just some ways that I think about risk and given the current environment. But to answer your question more kind of concretely and specifically, we exited a deal in Phoenix. We had a multifamily deal in contract in Phoenix that we backed off of last week.
Okay.
And it was simply because the deal is a good deal. It just was a little too marginal for us. And it was we felt like it was going to take up too much of our time and too much of our, it was unlikely to be a great return. It was likely to be a reasonable return, possibly even low, but it was unlikely to be a great return. So we cut that deal.
So real quick question, just because I'm curious. So what price did you go into contract at?
We went into contract at, it was just shy of 2.4 million, call it 2.35 million.
All right. So I'm just curious, if the seller had come back to you, and what number would they have had to offer you for that good deal to become a great deal and to get a yes answer from you? Did you think about that?
Yeah, we did. And so this was a moment when the seller, so this is an interesting difference, I think, between single family sellers in some instances and commercial sellers.
Mm-hmm.
Um, the seller was not motivated enough,
Sure,
right?
of course. But
Drop
I'm
their
just
price.
curious. Do you know the number? What would you have said
Yeah,
yes to?
I think we would have had to come in under 2 million.
So like 1.9,
Yeah,
1.85.
yeah, 1.9. Maybe even closer to 2 million. I think that would have still made, that would have provided enough cushion that it would have made sense for us.
So that's about 88% of your original contract price, right?
Yeah,
2.35.
call it a 10 or 15% discount would
Okay.
have
I was
would
just
have been.
curious. Thank you. I was just curious. All right.
Yeah, and that's going to depend on the deal, but I think
Of course.
that would have been reasonable enough.
Okay.
And
All
we
right.
had that discussion with the seller, but again, they weren't motivated enough, and maybe that changes over the coming weeks, right? We
You
don't know.
got it.
We don't know. But we do think as a buyer, our leverage increases over time
Mm-hmm.
because as this thing continues to play out,
Mm-hmm.
and really just shows how dramatic it's going to be from an economic, an economic perspective.
Yeah.
So, okay. So going back to your original question though,
Yes. Sorry.
we're just more heavily scrutinizing everything that we're doing. And we are going to be likely asking for price reductions on the two properties.
Oh yeah, I would think so.
Um,
Let's talk about the flex office. So pretend I don't know what that is. What does that mean? Is that just like a big rectangle where you, like a convention center, you can add walls and that's 600 square feet and that's 1,200 and that's, I have no, is that what it is?
Yeah. So imagine it's it's a single story. It's
Okay.
got a flat roof,
Okay.
built in 2001, tilt up concrete construction. When
Okay.
you walk inside, the structure itself is steel frame and it's kind of wide open.
Yep.
So you could use it as a warehouse.
Mm.
You could break it up into offices. Mostly, it could be used as a retail storefront in the front with a roll-up door in the back.
Mm.
So you could have a tenant in there that is maybe a granite or marble
Mm-hmm.
fabricator, right? So they have a showroom in the front, and in the back they do their fabrication.
Mm.
Or you could have a tenant who has their corporate offices in 40% of the space, and in 60% of the space they do light assembly and manufacturing or production of some kind of physical good.
Mm-hmm.
And so that's what flex space is. It's flexible in its use. It can be used for retail. It can be used for office. It can be used for kind of light industrial uses.
All right. And again, you're buying this. I'm guessing it's currently empty.
No. This
Oh,
is actually 100% occupied.
oh,
So
there we
this is
go.
100% is 100% occupied with long-term tenants. So the most important thing
Ah.
for this deal is that this is actually a consistent cash flow deal. It's going to provide a pretty significant, essentially dividend or annual yield,
Mm-hmm.
and it's going to be steady.
Got it.
We're really dependent on the credit worthiness of the tenant,
Mm-hmm.
and so we really need to understand deeply how we expect the tenants to perform through a downturn.
Mm-hmm.
And it's important that they have strong balance sheets, for instance. The primary tenant who occupies about 80% of the space, we dig into their financial history pretty significantly. And so we know, for instance, that they have 6 years worth of rent payments in cash and cash equivalents on their balance sheet.
Mm.
That makes us feel pretty good.
Mm-hmm.
But that's not enough. You need to know more about their business and what they sell and where you think their liabilities might be. And so next week, for instance, we're having another conversation with their management team to just kind of further drill into how is this affecting you so far? Have you had any layoffs?
Mm-hmm.
What do you expect to happen if this coronavirus comes back if we get, we kind of get through the first wave and it comes back in the fall? Mm-hmm. How have your supply chains, been affected? All those things, those become really important for us to understand. So we're just digging in further and making sure that we still feel comfortable in the tenant and the deal.
Well, here's a crazy question for you. The first thing I went to is I would offer them, hey, what would I need to offer you to have you prepay a year of lease? Right.
That's interesting.
Yeah. I'm just putting out numbers, right? If it's $2,000 a month, that's 24 grand a year. What if I gave you it for 21.5? Would you what would I have to offer to prepay a year lease. That's what
That's
I.
actually, yeah, that's not a bad idea. That's not a bad idea at all.
Hey,
I
look
love
at
it.
that.
Yeah,
You
yeah,
got some
no,
value.
yeah, that's great. No, and this is, but your point is exactly right. Like, we're real estate investors. We operate the deals.
Yeah.
We need to be creative. We need to
Yeah.
be flexible, and we need to go solve problems. We got a lot of problems in front of us right now,
Yeah.
and
And I think
we
their
need to figure out
answer,
ways to solve
because I think their answer will tell you how confident they are without them telling you how confident they are, right? Let's just use the example of 2,000 a month, 24K a year. If they come back to you and squirm and say, I want 12 grand, they're probably not as confident as they're fronting on their balance sheet.
it.
But if they come back at like 20 or 19 or 21, it's like, all right, they're, I mean, I think you learn just by what number they give you, I think
Yeah.
is interesting.
No, I think you're right. And I think that's the kind of thing that we can do, even if it's not 12 months, maybe it's 6 months or even
Yeah,
three
whatever. Yeah.
months. Gives you some kind of cash flow up front. You're probably willing to pay a discount for it.
But you're also
That's
testing the tenant. Because if they come back to you and say, I wouldn't even prepay 3 months,
right.
and then they're sitting there going, we're so confident. Are you really? Really?
Yeah.
Tie these two things together because they don't look so confident. All right. So
Yeah.
tell us about the 136 unit multifamily.
So this deal is this deal we're actually, I would say, potentially even more confident in, because we're buying this property at a very low, what we consider to be a low basis of, it's about $56,000 a door.
Oh, okay.
So the total deal is going to be 7.8 million dollars, and what we're buying is workforce housing. So the immediate liability is how many of these people are going to lose their jobs, and how many of them are going to be staying in in their unit but not paying. That's the difference between physical occupancy and economic occupancy. So that's something that we're going to look at very, very meaningfully. Luckily, we have another, call it 45 to 60 days before we close. So we still have quite a bit that we will learn in that time. But a lot of it is going to be understanding the tenants and their kind of their employment, and also what tenants are going to pay on April 1st. That's going to be an important.
Rent collection by April 5th is a number I'll be looking at for sure. Yeah.
So long term, though, we feel really good about this property. We're buying it at $56,000 a door. Things are trading at significantly higher than that. Comps are.
What city?
This is in just north of the North Carolina Virginia border in Virginia, in a city called Danville, Virginia, which is a relatively small town, but it's kind of part of the North Carolina Piedmont Triad area. So it's workforce housing, and we think long term it has lots and lots of upside. Rents there are below market. It's a really nice little clean property. So we don't need to make a dramatic change in the next 12 or 18 months.
Right.
We need to be able to make a change in the next 5 or 6 years, and we still see that as a tremendous opportunity.
Yeah. I'm just curious, what was the occupancy when you signed the deal? In the 90s, I'm guessing? Probably the high 90s?
Yeah, it was like 90, I think 92 or 93. So we'll be watching how that trends for sure.
Yeah, I gotcha. Yeah, and again, something I would be thinking about there on that deal is, because the seller's going to be nervous. Instead of going for a discount, I might say, hey, you know what? Why don't you give me, 60 days of rent credit back or something, right? You still get a lower price, but you sort of carve it out differently. Would be something I might play on there. So
that's right. That's a good point.
Yeah. So that way it just feels better, right? He still gets his 7.8, whatever. So he can still tell his friends, but then there's a line item on the closing that says rent back credit for blah, 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 whatever it is.
Yeah, exactly. Yeah.
So, pretty cool. So yeah, on my side, it's much easier doing single family, man. Kind of one unit, one person. Like you said, a workforce housing, I think affordable housing, probably the best asset to own, just like workforce housing. It's going to be a little choppy the next 60 days. but the federal government passed a $2.2 trillion bill, or at least should be passing it on Friday. The House has to sign.
Yeah.
So checks are coming. Unemployment's been beefed up, which I'm so happy about. Because again, we got to take care of the people, right? We've essentially told people to stop working through no fault of their own.
Yeah. Force them to.
Force them to. So I think the government's stepping up, which is really, really cool. So any closing thoughts on this this important topic? It'll be fun to see how these deals progress. And yeah, it's just interesting times, right?
Yeah, it is. It is interesting times. You got to have your head on a swivel. This moment is not for the faint of heart, for sure. It's been a roller coaster for us, and there's more. There's a lot more to come. I did want to ask you,
Sure.
have you had any tenants yet that have reached out and said, "Hey, I'm not going to be able to make my rent payment April 1st. Is there anything we can do to work something out?"
Yeah, I've had some, not as many as I expected. So let's just call it, I don't know, pick a number, 150 units. It's between 150 and 180. I actually don't count, which really drives people crazy, but I don't count. I think I checked yesterday, the day before. What is today? Thursday. So it would have been Tuesday. I think we had 8 or 9 that officially reached out and said, "Hey, I lost this, lost that." I also did a video like 2 weeks ago, "What if?" A video called "What If." So first off, we are going to be good human beings and work with everyone. We will, push a month's rent out and divide it up over months to come. We are making recommendations. There's lots of organizations that will help. It also helps to realize what part of the market I'm in, right? That, like you call it, workforce housing. A fair amount of my tenants are Section 8, so that money's going to show up no matter what. So we feel pretty good, but I'm budgeting a 10% hit. So if we collect 120 grand, that means 12 grand's not going to show up. I think most of that eventually comes. It's just going to be choppy. But worst case scenario, 50%, and then things get interesting for a couple of months. So it's I'll be checking in April 5th, and then April 10th, and then April 15th, because we've never seen something like this before.
And have you had any discussions with any lenders about your just financial position or your ability, or them saying, "Hey, do you need a month or two of forbearance?" Have you had any discussions with any lenders?
I won't do that until I actually have concrete data.
Yeah.
I am blessed, lucky, whatever you want to call it. I have a big pile that's free and clear. I have others that are LTV'd at 50%. I could limp along for multiple years at 50% of payment, right? That's certainly not what I want to do. It would certainly begin to impact daily life. So no, I'm not going to do that until, I probably won't even do that till May, right? I'll get April actuals, then get May actuals. And if it's really bad and there's one property that's hit harder than others, I'll probably call the bank and say, "Hey, we're going to have to do something." But I'll do that on an asset by asset basis. As I sit here today, I can't envision having that conversation with any of my banks, but I'm ready to, right? If like, let's just say I had 75 apartments and every single one of them didn't pay, that would suck, right? I'd be having phone calls, but I believe water, food, shelter. And as long as you're willing to work with folks, because again, I don't know. I believe more people are going to pay, or at least do partial payments, and I will work with them to get through this, because that's what I want them to do when I was younger, right? I've been very clear. I grew up very poor, where money was a stressor, and we were always days away from losing our resident. So I know how that feels. So I'm not going to put somebody in that position if I can help it.
Yeah.
And if that means I take a hit, so be it. Will I do that forever? No, this is a business, but this thing that's going on today is no fault of my tenants, and I will absorb it if I have to. Yeah.
Cool. Thanks for sharing.
Yeah, of course. So we'll stay in touch. I look forward to speaking next week.
All right, Michael. Thanks. Have a great weekend.